Thank you all for joining and making time for it for this webinar this evening. I'm your host, Kavita Baratake, and I'm the principal and founder of Cherry Street Investments. I'm here today to talk to you about how multifamily real estate investments work, why I think they make good investments, and how they're very different from single family investments, although they are in the real estate realm. I'm also going to cover a lot of material on what cap rates mean, what cash on cash returns, what are the typical returns, and what are the strategies that we employ with multifamily investments to increase the value and how we operate. So if you have any questions during the presentation, please feel free to type them in the Q&A box, not in the chat box. There is a separate Q&A box. So that'll kind of keep it easier for me to track the questions while they're coming in. I will try to get to the questions as I'm going through the slides, but if it gets too many, then I'll probably leave some for later. If I don't answer your question towards the end of the presentation and we run out of time, then I will follow up with email, but I'll try to get through all the questions today. So a little bit about myself. I'm a Texan. I consider myself a Texan for all practical purposes. Moved here from India to College Station in '98. I was a full-time IT professional. I was in IBM and then Atlassian for almost 20 years, between 15 years in IBM and about 4 in Atlassian. I recently switched over to real estate, and I'm full-time in real estate since June this year. Doing multifamily investments. I'm a single mom. I have a teenager who's almost 15 and 2 puppies. That's Oreo and Milo. The brown one is Milo, and the black one is Oreo, obviously. I initially started with trading stocks and options, and quickly discovered that it wasn't a very scalable model for me. I was just spending a lot of time on the computer, making and losing. It was too volatile for my taste. After about 3 years of doing that, I decided there's got to be a better investment that I didn't have to handhold so much and would still do well or provide good returns. So I actually turned to single family residential homes and started buying single family homes right when it was a downturn in 2009. I went through and started landlording it myself, like self-managing the homes, because I felt like there wasn't a whole lot of, there was some cash flow when I started with single family residential because the prices were low back then, but it really wasn't to the point that I felt comfortable, oh, I can hire a property management company and actually make money on this thing. It really wasn't that much meat on the bone. So I decided to self-manage it. And I also wanted the experience of self-managing, which I got very much. And I didn't want. After about 10 or 12, 11 of them, I decided I just can't scale this very well. And if people have lived in Texas, I don't know how many of you are in Texas, but our property rates, tax rates here range from 2.5 to 3.5. So as you can imagine, our with the increasing appraisals, the tax appraisals, they have gone up steadily in the last 10 years in Texas every year, and they're almost keeping up the appraisals with the market. So it's really hard to make money on single family rentals anymore because you pay, let's say, $800 in mortgage and you pay $700 a month in taxes. So it kills any cash flow there is in single family residential, which is why I started looking at multifamily seriously in 2017. And that sort of led me down this path where I started doing multifamily and discovered that there was cash flow and there is a lot of economies of scale. And we'll talk about all the advantages of doing multifamily in the next few slides. So I am a full-time multifamily investor. I'm invested in about, I think about 12 properties now, over 2,400 units, or as we call doors. They're basically the number of doors in each property. So before we get into the multifamily or single family versus multifamily, I really want to encourage you to think about what's your why? Like, why are you trying to invest? What is your end goal, right? All of us have some end goals in mind. And mine, when I started, was financial freedom. I wanted financial freedom or independence to pursue my passion, to pursue my hobbies, to spend more time with my daughter, and to be able to travel as much as I wanted. So I kind of, most of you, I'm sure, are spending this evening here on this call trying to do the same things, right? We all want to have that financial freedom. We love, some of us might love the jobs we're in, some of us might not. But either ways, we all are kind of going towards the path where if we didn't have to worry about money coming in, then what would we do with our time? So I do want to encourage you to think about that. So this is a very useful sort of breakdown of how employees versus self-employed versus business owners stack up. And if any of you are familiar, and if you haven't been exposed to this, I highly encourage you to read Rich Dad Poor Dad. It's by Robert Kiyosaki, and this cash flow quadrant is again another one of his books where he talks about how as an employee, as a self-employed person, we end up on that left side of the quadrant. You see the blue side of the quadrants, the two quadrants, where we pay the highest taxes being either an employee or a self-employed person. And we're also actively working for money. So that's active income versus the right side of the quadrant, which is the passive income. When you're in an active income job, obviously, if you don't go to work, it's not like your employee is going to pay you after maybe your vacation time is done. So in that sense, you're always actively working for the income that you make, and you're basically trading time for money. So you time equals dollars there. So you have a job. And it doesn't get any better when you're self-employed, where, let's say, you're a doctor, you're a dentist, you are employing yourself, but you still sort of own a job unless you have a practice with multiple people in it and you run the practice, right? So when you're away, you still can lose money or are not actively making money. And the other negative, the biggest negative of being on that employee and self-employed side of the quadrants is that you end up paying high taxes. So you pay between 40 to 60% taxes when you're on this side of the quadrant. Now, getting to the green side of the two quadrants there, the passive income quadrants, they are either a business owner or a investor. So with the BNI, you either own a system or people work for you, where you could still be out in Hawaii playing golf and your business and your people are still working for you. So you're, in that sense, using people to leverage and make dollars. And you're still making money even when you're not physically present. So the same thing works as an investor, and actually works really well, where you create passive income. When we say passive, it means that you're not actively working for that money. So you're not trading time for money. The biggest advantage of being in the BNI quadrants is that you pay the lowest amount of taxes. And this is how we hear about people who pay almost no taxes in a tax year, right? Because they are investing wisely. They are taking advantage of the tax deductions available for business owners and investors, which are plenty, because the economy has to be sort of more, the government will subsidize and make the business owners as well as investors, incentivize them to invest in the economy and create jobs and clean up areas that need more money. So all of those are incentivized with tax deductions. So we'll talk a little bit about how real estate can help you save on taxes. So just be aware of the fact that if you are trying to become a passive income, get passive income, you want to be on the B or I side of the quadrants. So let's talk a little bit about passive investments. What does a passive investment mean? It means your money is working for you even when you're not. So you're not putting any ongoing time or effort investments. Also, in terms of passive investments, you can have two kinds. One is called a debt instrument, and the other is an equity instrument. What is a debt instrument? Let's say you have a home mortgage. So that's a very classic example of a debt instrument where you pay your mortgage company a fixed income or interest every year, every month, and that let's say the interest rate is like 4.5 or less than 4 right now. So you just pay them every month you make a monthly payment based on the 4% interest. So the disadvantage of a debt instrument, let's say you become a lender, right? You use your money to lend. The disadvantage is usually the returns are lower, like a mortgage is low. Fixed upside, you don't get to participate. If my house value increases and I have a mortgage, my lender is not going to benefit from it. So they don't get any equity portion of the deal. They just get like a fixed upside. Of course, it's a lower risk because they're not, they're just receiving monthly payments from me. There's also no participation in equity. So bonds and mortgages are classic debt instruments. With equity instruments, you can have variable upside, which depends on the performance of the asset. So there's both cash outputs or distributions, as well as equity returns. There's higher risk, of course, involved because you're now buying into the equity of the property. So examples like stocks and multifamily investments, but there's also higher returns that come with high risk. So multifamily investments that we'll talk about today are equity instruments. So why go passive with multifamily? So if any of you have owned a home, I mean, these are all the things you'll have to deal with. And what's funny is actually just before I hopped on this call, I was just stressing out about getting everything right. And I got a call from my tenant and she says the AC is broken. So as you can imagine, this is sort of like a landlord's life. The more properties you have, the more calls you get. And it's just added. I mean, you can have a management company. It doesn't guarantee that they will handle everything seamlessly. And, I've had horror stories with management companies as well. So regardless of what you do, you can't get away from all the management hassles of a single family home when you own them and own a substantial number of them. And that's why I think multifamilies always makes a good investment versus single family investments. So when I talk about a typical multifamily deal, we don't usually go for small number of units because, again, we want to take advantage of scale. The larger we can go, the better it is. And usually in most markets, what's defined as a good number is 50 plus units. So when we talk about size of a single family investment, even if you take like a 4-unit, we still consider it pretty equivalent to single family because you're not really taking advantage or getting advantage of the economies of scale until you typically get to about 50 units. Also, the cost of a single family home or a duplex or even a fourplex is based usually on comparables, right? It's not directly based on what the property is making, but it's rather based on what your neighbor's house sold for. So on the other hand, with multifamily investment, the value is entirely based on the net operating income or what the property is making, as well as what we call the cap rate of a market. And I'll get into the nitty-gritties of a cap rate in a future slide in a few minutes. Also, when you look at scale, the scale, the per door cost is higher for single families and even duplexes and fourplexes than when you go 50 plus doors, because obviously as you scale up the number of doors, your per cost door sort of goes down. Sort of like thinking about it as you're buying retail versus you're buying wholesale. I mean, you can go buy a single family wholesale as well, but you still don't get great deals anymore in the market. Whereas in a typical house in Austin, let's say it's a 250K house, we are able to get like a similar apartment per door at about 150K or even 125K. So with the management company, your management costs for single family homes can run between 8 and 10%, whereas the typical cost for a multifamily large investment is 3 to 4. So again, you can see where the economies of scale are playing in. The rehab costs also. If I'm going to go fix up a house, it might cost me $10,000, $15,000 depending on what I'm going to do with the house. And a typical rehab for a multifamily investment might run me $5K in Texas. Again, it depends on the labor and the market and all that. But again, if I compare the single family versus multifamily, multifamily will always come out ahead. So due to all of these factors, it just makes more sense to own more units. But obviously, I'm not going to jump in and go buy a 50-unit property by myself because it might cost a couple of $1 million, and I might not really have the capital for it, right? So what do? We do syndications. So what is a syndication? It's basically an effective way of for a group of investors to get the capital together and invest in a larger property than if they can do by themselves. So maybe some of you can do a 50-unit property. A couple of million might not be an unreasonable number for you, but some of us can't. So what do? We group together those investors and buy a larger property. So right now we're looking at a 212 unit property, and obviously this is like a $26 million property, and we can't really go buy that property by ourselves. Most of us can't. So this is ideal for people who will have full-time jobs and families but still want that exposure to real estate. And I talk to a lot of people about this because a lot of people come to me and ask me that they want to invest in real estate and how they can go about doing that. And they always think single family homes. And I always try to kind of veer them away from that because single family homes don't really make any money anymore. And you can't really invest at this time in the market cycle for appreciation anymore. So you're sort of buying into the high of the market, and I don't know where it's going to go from us here, and none of us do. So I really strongly, if you're thinking of a single family home, I ask you to, sort of reconsider that at this point in the market cycle. Because one, it's going to tie you up, keep you busier than you want to be. And also right now, there's probably not going to be a whole lot of appreciation, contrary to what people keep saying about Austin market or anywhere, wherever you are. So there's market cycles, and we are going to go through a down cycle. Of course, we'll be back up, and areas like Austin might come back up. We don't know. It'll probably in the long run come back up, but this is not the buying opportunity, right? You kind of want to wait for that dip to happen. So in a typical syndication, you have the sponsorship team, you have passive investors in the green there. The passive investors bring in the money. They are passive in the sense that they're not putting in time and effort into the deal. The sponsorship team, which is a group of individuals who get together, who have that time and experience to put into this property, will get together, get that sponsorship team together, and start putting the apartment syndication. So as a sponsor and a general partner, what do? I perform the underwriting on the property, the identification and acquisition of the asset, also manage broker, lender, and investor relations. So there's the multifamily space is pretty complex. It's not like going and buying a single family home when you're investing a lot in buying multi-billion-dollar properties. As you can imagine, there's a lot of groundwork which goes into it. So underwriting is where you kind of put together like a 5-year plan for the property. So we do what is called a pro forma, which is a projection of how the property is going to perform. We identify what property we want to buy, and we go ahead and acquire it. Again, we might underwrite, I don't know, 10 properties or 20, 30 properties before we find one that we like and where the numbers actually work. So it's a more complex process than just finding a property and buying it. We also manage the multifamily broker, lender, and investor relations. We work with attorneys to form the LLC and legal paperwork. So whenever we put out these investments, they are securities. So we have to form the proper structure as well as form an LLC for liability protection for this individual apartments. We also work with property management companies on an ongoing to perform the ongoing asset management. A property management company, we hire professional property management companies to manage these properties because they're large properties. We are not going to try to do it ourselves, but we do have to manage the managers sort of. We have to make sure that they're on track. So that's the asset management piece. We also come up with a business plan. Whenever we buy a property, we see, okay, X, Y, Z things. These are the things we can do with the property to improve the property. And we lay out a business plan and then execute that business plan over a period of time, which normally tends to be about 5 years. And I'll get into it a little bit more as well. We also manage the disposition of the asset as well as the distribution of the investor funds after the property is done with, we are done with the property in terms of its cycle. So do we hold for the entire 5 years that we plan to hold the property? Not always. If the property is, it's favorable to sell the property early and we can still make good returns, then we do sell it early. So I'll take a pause here and see if there are any questions before I keep going. I don't see anything in the Q&A. I just want to make sure I'm not missing anything. Okay, I'll keep going. So as a passive investor or limited partner, what do? You provide the cash investment. You receive the cash on cash distributions on a regular basis. Usually we pay out quarterly distributions. Although you will get monthly updates from most sponsors. Some sponsors might send quarterly updates to you. Updates meaning here's what's happening to the property, here's what we're doing. You get reports from the property sponsors. So a passive investor, yes, someone just asked, just making sure the Q&A is working. Yes, I can see that. Thank you, Judge. So a passive investor or limited partner is an equity investor that benefits from both the appreciation as well as the cash returns, like I mentioned before. So what are the different classes of multifamily assets? We have class A, B, and C. I also want to point out that an asset itself has a class, but a location has a class as well. So just keep that in mind, and I'll come back to it again when I speak through properties. So when you see a fancy building, built in the last 10 years, it's usually what we call a class A building. And then we have the class Bs, which are built within the last 25 years, 80s, 90s, and so on. And the class Cs are generally 60s, 70s, and older. So the amenities in these different classes of multifamily are like, they sort of range from high to low, from A to C. So for example, the A's might have valet trash and all the fancy stuff like dog parks and everything else. The B's might have some of those, but not as many as A's do. And the C's generally are very skimpy on the amenities because it's basically workforce housing for people making, let's say, 40, 50 or below, somewhere in that range. We actually prefer investing in B's and C's because they stay pretty stable through recessions, because the class A's are the fancy expensive apartments. So what happens is, as there's a lot of new build happening in a particular market, let's say Austin, I see a lot of new build happening. All these new units start coming online. They're class A units, obviously, because they're just brand new. The class A units coming online and the class A properties existing will compete with each other because they are demanding similar rents. But the class Bs and the Cs, they usually are lower on the rents. So they're not competing with the class A properties. So they have their own niches and they could cater to different audiences. So the class A is catered to usually the median income, where the median income is really high, and the class Bs are really strong still, but not necessarily catering to the highest income groups. And the class Cs are usually the lower income groups. And there's a class DE. We don't really want to get there, and we don't want to invest there because there's a lot of problems in doing that. So we usually tend to stay between the Bs and the Cs. In terms of deferred maintenance, is nothing but just the property and the amount of upkeep needed in the property. The class A's obviously are new and they don't really have a whole lot of deferred maintenance. So the deferred maintenance is really low. And as you get towards the class C's, the deferred maintenance gets higher and higher, which is not necessarily a bad thing because it gives us an opportunity to go in there and fix the property and make it look really good and push the rents up a little bit. And that can make a huge difference in the bottom line, as well as the valuation of the apartments. So I'll talk about that and how the valuation is affected by the income that the apartment is making. So as far as the cap rates are concerned, and again, I haven't explained what a cap rate is, so I'll hold off on this. Just remember that the class A's are the lowest and the class C's are the highest in a given market. So as you can guess, this is a fancy class A apartment. I'm going to take a sip of water. This is what a typical Class B looks like. You could immediately, versus this, see the age of these apartments, right? They're usually about 20 years old, or 10 to 20, maybe 20 to 30 sometimes. So these are Class B apartments, still very clean and very habitable. And these are typical Class C apartments. So now that you're familiar with the classes, I also want to talk about, before I get into this slide, I want to mention briefly locations. In addition to the apartments themselves being a Class A, B, or a C, the locations can also be a B, or a C, or D even. What that means is the Class A locations, your top-notch locations, maybe you'll see a Starbucks there, maybe you'll see an Orange Theory Fitness there. So they're really good locations with very high median income of the demographic or the tenant demographic living there. General median income of the area tends to be very high. And as you get to the B location, it's a little bit lower, and the C location is obviously much lower. And when you start getting to the D location, it's the income level goes down some more. And it's interesting when you start looking at these, the stores around there, like Starbucks, usually A or B location. Dollar store, usually a C or D location. So just something for you guys to keep in mind when you start looking at apartments. You can have a Class B apartment or a Class C apartment in a Class A location sometimes, because it's an old apartment, it's an old area that's really gentrified, grown a lot, and it's still in a great location, but it is an old apartment. So the best thing we can do is buy a Class B or a C, improve it, and put that, or buy a property in a Class A location, or a Class B plus location. So just to keep that in mind when you look at properties, that there's not only just the classes of the property, but also the location. So why passive multifamily? One, of course, it provides passive income. We'll talk about the concept of forced appreciation in apartments. We'll talk about some of the tax benefits which are unique to apartments and multifamily, called depreciation, accelerated depreciation. It's unique to commercial. I'm not sure if it's available for all asset classes, but definitely available in multifamily. Also, recession-resistant asset. We talk about why this is true, why it's a recession-resistant asset, and how the economies of scale benefit apartments, and also talk about some other benefits which I think apartments will provide an investor. So we talked about passive income. Put in the money and no time effort. You get the cash distributions, which is paid from the cash flow, usually on a quarterly basis. The income is what generates the cash flow. So you have the rent, you have pet rent, you have laundry, you can have utility bill backs, parking, and late fees make up for the income. The expenses will be property management, payroll, just some of them listed here. I don't want to read them out. The net operating income, and this is very important to understand, the net operating income of the property is the income minus the expenses. Pretty simple calculation. But remember here that the expenses does not include the debt service, which is your mortgage payment. That's always calculated separately or considered separately in an apartment. So you just rely on the net operating income, because different people can place a debt at different interest rates. So we don't take that into account when calculating what that apartment is making. So your net cash flow is actually NOI minus the debt service, which is depending on what debt or mortgage you place on the property. And your cash flow is what determines your cash on cash distributions. If there are any questions, feel free to type them in the Q&A window, and I'll keep answering them as I'm going along. So what does a typical return look like in a multifamily, passive multifamily investment? We have two kinds of returns. We have the cash on cash return, which is based on what I just told you, which is the cash flow. And then we have the equity returns. The equity returns are usually not paid out, obviously, until the property is sold, because we don't realize the equity while we're holding the property. Of course, we can always refinance the property and pull the equity out. So that's possible for the property not to be sold and still for you to get your equity back. So generally, though, if you don't refinance, the principal and equity will be paid back at sale. And let's just take a relatively simple, let's say $100K investment. then essentially what you're making is usually about 7 to 10% cash on cash returns, which is paid out quarterly. And that's a 70 to 10% annualized. So if you're holding the property for 10 years, you're basically making 70 to 10% every year on that property. And the equity returns, which are realized at sale, generally amount to the remaining portion in that total returns of 15 to 20%. Just to make it really simple, let's say I do a 100K investment. What that means is at the end of 5 years, I get between 175K to 200K back along with my principal. So you make that extra 85, 75 to 100K back. So there is a question, and I just want to make sure I get to that. Someone new to multifamily passive investor, what is usually the minimum investment needed or average people do in the Austin market? So there is no average in the Austin market specifically. Generally, most apartment investments will start usually around 50K and go up to 100K minimums. But I have seen investments even at 25K for smaller properties. So typically, I'd say 50 to 75 is very normal for a minimum investment. So if you have a 100K investment, so you usually are making 15 to 20% total return annualized over a 5-year period. So you could bet between 80 to 100% returns on your investment. And so because this is backed by a physical asset, like we are actually buying into an apartment, so you'll be a part of that LLC that is buying the apartment. You'll be one of the members of the LLC. So it's relatively low risk because it's backed by a physical asset. Your cash flow can sometimes be impacted. I've done about 12 investments, and one of mine is definitely impacted as far as cash flow because there's a lot of bad debt in the apartment. When you do enough investments, obviously sometimes you can make mistakes and invest in some places you shouldn't. So I invested in a really bad location, and I've since learned my lesson that location is one of the most important things when you buy into a property. Because if you buy a bad location, your bad debt, which is, tenants not paying, tenants just leaving, can be very high. And that can lead to impacting, negative impact on the cash flow. If there are any questions, feel free to ask. I'll keep going ahead otherwise. So what is forced appreciation? I wanted to explain the concept of forced appreciation because this is sort of unique and not a single family normal thing in single family. What we do in apartments is that if we can impact the net operating income, then the valuation can be pushed up as far as what the apartment's worth. So that's kind of our play on what we do with our usual offerings. We buy an apartment, we figure out, okay, where are the places we can possibly push up the value, and we implement those business that in our business plan, and we increase the net operating income. What we cannot impact, and which is determined by the market as well as the sub-market and the class of the property, is the cap rate. And I'll talk in the next slide, I think, about cap rate. So as you saw before, net NOI was income minus expenses. So there are two ways we can increase the NOI. We can either reduce expenses or increase the income, or we can do both. And which is what we usually try to do. We try to increase the income and reduce the expenses at the same time. So in effect, increasing the NOI of the property. So the forced appreciation is essentially identifying these factors and increasing the NOI of the property and therefore the valuation of the asset. So let's talk a little bit about cap rate. What is cap rate? It is a very popular measure for assessing the real estate investments for their profitability and return potential. So for example, cap rate is defined as NOI by value times 100, which is a percentage. So if I have an NOI of $100,000 and a value of the property, let's say, is $1 million, then essentially the cap rate of the property is 100,000 by a million times 100, which is 10%. That's what a cap rate is defined as. What does it actually represent? It represents the yield of a property, assuming that the property is purchased all cash and that the yield over a year. So as you can see, if you're making $100,000 a year on a property, which is the NOI, That's the yield of the property, but you don't assume the debt service in it. So it doesn't assume that you're buying with the debt or mortgage placed. It assumes that you're paying all cash for the property, which is obviously not true in most cases. But we still use this measure to kind of figure out, okay, what is this property capable of doing if I purchase it with all cash? So it's sort of like a measure of that. And cap rate is also a measure of the perceived risk of investing in a market. So for example, let's say I have a high risk market like Brownsville, Texas. Why do I call it a high risk? There's not enough job growth. There's not enough um, job growth and population. So it's usually a high cap market, which means you get great deals. So you can get a 10 cap. There are some questions and I'll get to it after I finish the slide. You can get a 10 cap rate in Austin, for example, because Austin is a very low risk market. And why is it a low risk market? Because there's a lot of jobs, there's a lot of growth here. People are anticipating that the economy is going to do pretty well over, let's say, the next 10 years. So there are more investors in the Austin market than, as you can imagine, than in the Brownsville market. So when an investor perceives the market as a high risk, then the cap rates will be higher because there are fewer people investing and the demand is low as well. And like something like Austin, Texas, which is considered a low risk market, then the cap rates are super low. So we are seeing anywhere between maybe a 3.5 to a 5 in Austin. So what again plays into the cap rate is that the class of the property also plays into the cap rate. So let's say an Austin market, a class A might be trading at a 3 cap, a class B may be a 4 cap, a class C may be a 5 cap. Again, it's not exact, but it's usually there's a market trend around cap rates. So there are 3 factors then which plays into the cap rate. So there's the risk of buying into a market, there's a class. Within a given market, there's usually different ranges for different classes of properties, and also it defines how much the property is returning. So when you go to a place like Brownsville, you're capable of making much more cash flow, but it doesn't mean you'll make more in the long run. It just means that the cash flow is higher because the cap rates are higher. But where you might get hurt is the equity component, because it will not go up in Brownsville like it goes up in Austin, right? Like over a long period of time, the appreciation in Austin is so much more. So I think there was some questions, so I'm going to answer them. So the class A's is the lowest cap in a given market. So let me just get to these questions before I keep moving ahead. So mortgage goes as expense. No, mortgage does not go as expense. So like I mentioned in the earlier slide here, your expense is just income minus your net operating income is income minus expenses. Your mortgage is on top of the expenses. So when you get the numbers, or the what we call a trailing 12, which is the last 12 months of profit and loss on our apartment, like all the expenses and income for the apartment, then you don't see debt counted as an expense. That is considered to come off the NOI after that. So it doesn't technically go as an expense. I hope that answers the question. What other factors other than location go into the risk or cap rate of the property? Location, the submarket as well. Sometimes, let's say Dallas, if you're going to Irving, a property in Irving might trade at a much lower cap rate than a property in South Dallas. So it can be crime rate, it can be just a Class C location versus a Class A location. And mostly it's just the risk, right? If I'm going to go, I mean, again, that kind of pulls into the risk, which is if I'm investing in Irving, Texas, it's going to be a much better property than if I'm investing in South Dallas in a high risk, high crime area. Okay. I don't see any other questions, so I'll keep going ahead. I want to give you an example of how forced appreciation might work. So I have a 20-unit apartment that I purchased for $1 million. The rent is $1K a month per door, and that makes $20K a month. for all the 20 doors, which is 240K per year. Now your expenses, let's just say everything included is 140K. We're not taking into account debt service here. So just income, rent, and expenses. Your net operating income in this case is 100K, which is 240 minus 140. And your purchase cap is the NOI divided by purchase price times 100. And you saw that this works out to 10%, right? As we saw before. So let's say at sale, what I'm going to do is in 2 years that I hold the property, I'm going to increase the income by $50 a door over 2 years, right? So every year I'm going to increase the rent by $25. So over 2 years, I made it a $50 increase. So the net effective income increase is about $12,000 a year, which is 50 times 20 doors times 12, which is per year. So you reduce, let's say, expenses by 8K here by utility buildbacks. I found out that the landlord was paying for water, and tenants were abusing that and using a lot of water. And I bought the apartment. I decided I'm going to build back the water and have all the individual apartments or tenants pay for the apartment. Then essentially we have increased the income by 12,000 and reduced our expenses by 8K. Now let's see what it does to our sale. So at purchase price, remember purchase NOI was 100K. The new NOI is now 120K, right? We increased the income by 12 and reduced the expenses by 8. The new value is now NOI divided by cap rate, because the cap rate equals NOI by value. So value is NOI by cap rate. So it's 120K divided by the NOI, assuming the exit cap, the cap rate stays the same, which it doesn't. So that's another factor we need to take into account. Cap rates can change over time. So when you have an economic cycle, at the high of the economic cycle, the cap rates will be really low, right? When the prices are really high, cap rates are really low. Whereas in the recession period, the cap rates can dip. How much do they typically dip? Like 1 to 2%. So most markets we see, depends on the market again. The Austin cap rates, let's say Phoenix cap rate, I'm very familiar with that, has between 2008 and now, it has gone up or gone down from 7% something to 5. So the cap rates have changed from 7 to 5. So the swing of 2%. So, but for this, for the purposes of this calculation, we'll just keep it at 10, right? So the new value is now 1.2 million. So effectively, what did we do? We increased the value by 200K just by increasing the NOI by just 20K a year. That's essentially the play we use on all these apartments. So let's say I 10x this. I buy a $10 million apartment building and do the exact same thing. You could achieve a $2 million increase in the apartment. And that's kind of how we make money. There is a question here. Someone's asking in the chat, so I'm sorry I didn't get to it earlier. If you can just go to the Q&A and ask the question so I don't miss it. Could you clarify what you mean by low risk? Because it's backed by a physical asset. I would have expected the debt holder to get dibs on the property and the equity investors don't get any part of the physical asset. You're right. The debt holder will obviously have the first tips on the property, but you are still holding, as long as you're holding equity in the property. So usually we don't get into these with very low equity. So we don't usually get 80-20. We usually might pay 65, 35 or 70-30 or something like that. So depending on the amount of debt you place on it, you still have equity in the property as an equity investor. So you do have that physical asset. I mean, it's granted that it's not the first lien, because the debt holder will have the first lien on the property. So some of the tax benefits, I don't know why this worked like this, but let's work with this. So we have a single family All right. So with single family homes, the depreciation, as those of you who own single family homes, the depreciation is calculated over 27 and a half years. So if you have a property that's worth 200K and the land's worth 75K, then the depreciation will be taken over just the improvement value, which is 125K divided by the 27 and a half years. So that's 45 a year. So your tax savings on it is the marginal tax rate that you might fall under times whatever the depreciation is, 45. So if you're 30% of 45, that's not a huge amount of savings per year. And what's great about multifamily is that there's a huge amount of depreciation which can be taken in the first year. So we'll talk about cost segregation and bonus depreciation. Cost segregation, you can do this as single family properties too, but cost segregation is so expensive to do that it doesn't make sense for a single family home most of the time, unless you're in California and your house costs a couple of $1 million. Cost segregation studies can range between $30,000-$50,000. So it's just too expensive for a single family home. So cost segregation is basically where you depreciate different systems over different timelines. So for example, your plumbing, electrical will depreciate on a different schedule, like over a 5-year period versus the structure itself. So we take advantage of that and figure out where we can depreciate faster. And with something called bonus depreciation, which is the recent TCJA, Tax Cuts and Jobs Act has allowed, is that we can take 100% bonus depreciation in the first year. What this means is what we were able to take over 5 or 10 years, now we can take everything in the first year. And this, as you can imagine, provides a very huge tax savings to offset any gains from the investment. So generally 70 to 90% can be depreciated on an investment, which means if you, let's say, typically invest about 100K for an investment, your first year depreciation is anywhere between 70 and 90K. And you can apply that as a loss towards any passive income you have. And if you are a qualified real estate professional, a realtor, a mortgage broker, whatever, you can actually offset your income with this depreciation, which is why it's very powerful for especially qualified real estate professionals, or if your spouse is a qualified real estate professional and you have a W-2 job, you can offset your W-2 income with the depreciation as well. As always, I'll say consult your CPA, but that's what I know and what people I know have done as well. And I'm actually doing that this year. So why is this a good asset? Like I believe multifamily is a good asset because housing is not a discretionary expense. People always need a place to live. And we are finding that more and more millennials and baby boomers are moving towards renting rather than owning because they just don't want the hassle of owning a house. And house ownership is getting to be an all-time low right now. The class B and C multifamilies have very high occupancies historically due to downturns, because as people lose their single family homes with foreclosures, then we start seeing an uptick in the multifamily. It can also cash flow in spite of vacancies and bad debt, because again, in a single family home, you have one unit. It's either making money or it doesn't. But with 50, 100, 200 units, even if some of them are vacant or we have bad debt, we are still able to cash flow on these properties. So the valuation, again, as it's explained, depends on the NOI of the property and not the comps. So it really helps keep the value as long as we are keeping the NOI high. And of course, the cap rates can go down and the valuation can go down, but it's still the valuation or the cap rates fluctuates less with the market, ups and downs, than in a single family home. So case in point, Phoenix went down almost 20 to 40% depending on the location in the 2008 downturn, whereas the multifamily cap rate spread was only 2% through the downturn. So it is a much stronger asset in a recession. We covered most of these: low purchase cost, rehab costs, property management. We're also able to negotiate property taxes much better because we have legal representation. And since we have a larger property, we are able to hire good legal representation. We're able to get better taxes or protest taxes and get them down better in a multifamily world. We tolerate better vacancies and bad debt and loss to lease, below market rents. You're also benefiting from the sponsorship teams who have real estate experience. They're experienced real estate investors who often have very many years in the industry. Professional property management companies who are doing the leasing rehabs. It's not like a small management company. They're usually large companies. The accounting is not something you'll have to handle. The books, you just get K-bonds and you can file your taxes. So it's managed by the sponsor and property management team. As far as you're concerned, there's zero management hassle. Even though you're dealing with real estate, you're not landlording, you're not dealing with tenants or calls. And none of the headaches that come with investing in real estate, which is single family homes. Also, other benefits, commercial multifamily loans are usually non-recourse loans. So the worst thing that can happen is the property can be foreclosed, but they don't have any implications on your personal credit. And so you don't have any personal credit problems with a multifamily investment going bad. Whereas if you own a single family home and you're not able to pay the rent or pay the mortgage, or you're not able to sustain the property and keep the property afloat when it loses value, then your personal credit is on the line. The sponsors are guarantors on the loan, and the property is held as a collateral in the non-recourse loans. There are also no liability implications. We purchase the property in an LLC that the investors are a part of. And in addition, if investors want an additional layer of liability protection, then they can also set up an LLC to be an investing entity for that other additional layer of protection. Last but not least, you have portfolio diversification. Stocks and index funds provide good returns, but they swing wildly with the market. So I think that investing in real estate is a must for every portfolio. And studies have shown that the wealthier people tend to have more 60-40, like 60% in real estate actually, and 40 in the stocks and index funds and the stock market generally and bonds. Whereas traditionally, we always talk about this 80-20 split, with 80% in the stocks and bonds and then 20% in alternative investments. So, but I think real estate does provide high returns, which is backed by a tangible asset. So you can also get exposure to different markets across the country by buying in syndications, whereas buying in single family homes across different markets in the country is really difficult unless you have property managers and all, and you understand those markets. Here, you don't need to personally understand every market because the syndication is doing their legwork. And of course, you have to do your due diligence in understanding the market as far as vetting the sponsor as well as the property, but you're not really personally working in the market. So I want to briefly take a pause here and see if there are any questions. I don't see anything. So I'll go to value add and yield play. What is a value add play? Where value add play is essentially us buying a property and figuring out how can we add value to this property? How can we increase the NOI to the property, which can be either reducing the costs, the expenses, or increasing the income, like we talked before. Just make sure I'm not missing any questions because something's popping up here, but I don't see any questions, new questions coming up. Oh, there it is. Okay, there are a lot of questions. I'm sorry. I didn't scroll down. Okay, can you speak to the tax benefits? I hope I answered that question, the tax benefit. We can take depreciation only in first year. Yes and no. You can roll over the depreciation for year to year. You can carry it over. But yes, we take all the depreciation the first year. So if you don't you have any unused depreciation, it can be carried over. Should we expect the sponsors to take loan with recourse? I don't know. We do take some recourse loans, but the way we put skin in the game is that shows skin in the game. That's what the question is. We put our own money in the deal. So generally, when we are doing a deal, we also put in our own money. Let's say we are raising 10 million, we might put in $1 million of our own cash into the deal. So I don't expect that doing a recourse loan is necessarily a good thing. And we usually do non-recourse for larger properties anyway. Is there any opportunity to invest? Yes, I will have opportunities to invest. We can talk offline. If you want to reach me, I will have my contact information later. if you don't have any cash to invest, can you purchase multifamily units with private money, meaning through lenders? No, you cannot. Um, you can buy with private money. That's exactly what we're doing here, right? We use other people's money to buy the property, but we also add our own money to show skin in the game. So no lender is going to lend you 100% of the property. So you still have to come up with the down payment plus all the closing costs, which tend to be around the 30% plus range. I think those were all the questions. If there are any other follow-up questions, feel free to ask them. Okay. I'll keep going ahead. Sorry, I missed the questions earlier. Value add play versus yield play. So a couple of things we might do with the property. We might upgrade the units to increase rents. We'll do very basic upgrades, maybe 4 or 5K, put in like new flooring, vinyl flooring. We might resurface the countertops. We might paint the cabinets. We might change out the vanities. Simple stuff, but usually, again, doesn't cost a whole lot because we are doing this at scale. Usually 5K per door is very normal. Convert unused storage to units to increase the number of units. Anything we can add to the income in terms of rental, that basically boosts our NOI up. We implement reserve parking. Sometimes we don't need to implement anything. We just say there's not enough parking. But if I offer reserve parking so the person could park in front of the house, they are willing to pay $20 a month or $15 a month. So we can add up value to the apartment just by doing something so simple, like painting a little number on the parking lot showing that it's reserved. It also, usually it requires capital expenditure, but parking, for example, is a very simple, reserve parking is a very simple one to implement. So we can have a number of ways to where we figure out how to add value to the apartment. In an yield play, we're looking more of, okay, the property is cash flowing as it is. We are buying a property primarily for its cash flow. We might see improvements to make in the yield play as well, in which case it becomes a hybrid where we are primarily holding it for yield, but also see a potential way of adding value to the property. So obviously when you take a new property, like a Class A property, it's harder to add value because there's nowhere, it's already a brand new property, like where do you go and add value? So that could be more of an yield play, but then again, your cap rates are low, your returns are low on Class A's, so it's harder to get that number working for you. That said, there are people who have done yield plays, but the Class A's tend to be dominated by the institutional investors who give much lower returns to their investors through REITs and larger funds. So that sort of is their stronghold, and we tend to focus more on the B's and the C's. Just making sure there's a questions. Okay, some more questions. Are there small investors? As a small investor with limited funds, how do I start? Probably not here. I mean, there are 25K investments, but I don't know what limited funds mean. So we can talk it out later. You're welcome to contact me directly. Do you think multifamily has been played out in Texas? Where in Texas do you still see opportunities for multifamily? I think all markets are high right now. Does that mean in Texas specifically is super high? I mean, we have seen a lot of growth in Texas, job growth, population growth. So it is high, yes. But as long as we are able to get into a solid property that's cash flowing, let's say 8% a year, I think it's still a better investment than putting it in the stock market or keeping it in your bank account. So you might not see as thick a deal where the cash flow is not as high and the returns are not as high than you saw maybe 10 years ago or 5 years ago. But I still feel that multifamily is one of those spaces where there is solid cash flow, there's solid occupancy if you buy a good property, and you can sort of use that as an investment tool to tide over this uncertain period where we might see a potential downturn. Where in Texas do you still see opportunity? We still buy in Dallas. I mean, believe it or not, we still buy in Dallas. We still make money in Dallas. Even though it's pretty played out there. We buy in Abilene, Texas. I mean, great cash flow, lower on the equity portion. It's just not like Austin's probably one of the hardest markets to buy right now because the cap rates are so low. But we see opportunities all over Texas, and we typically don't go to Brownsville because, again, the equity component and the risk is too high for us. We stay in strong markets with good job growth and solid economies. Are there times in the market cycle where VA is better than YP? Value add is better than yield play? Yes, obviously right now is not a great time for yield plays because the cap rates are so low. There's not much yield, right? So we are banking on more value add at these times because we can go in there. We could buy, let's say, a property at 4 cap, but do a pro forma at 6 cap because we see ways to increase value. We see that the rents are under market. We see that there are other areas we can improve the property. So I'd say generally the high of the market, which is it is now, is a better time for value add strategies than yield play, and the low of the market is better for yield play. Okay, I think I can get back here now. I don't see any other questions. What is an accredited investor? So these are some terms you need to be aware of when making multifamily investments. I'm a little over an hour. I'm sorry I'm running a little over, and I hope you guys are able to stay. So we'll just talk about the Securities and Exchange Commission, how they define an accredited investor to be. You are an accredited investor if you make $200,000 or more, or $300,000 with the spouse in each of the last 2 years, and reasonably expect to make the same the current year. You have a net worth of over $1 million, not including your primary residence. This is or one of the two, and you don't have to be an individual. You can be a partnership or a nonprofit. Who's a sophisticated investor? Anybody that's not accredited is a sophisticated, provided they have enough knowledge and experience in business matters. You've done other investments. You understand how to evaluate the risks and merits of an investment. There are no income requirements for a sophisticated investor because you're not accredited, basically. And we as can sell securities to an unlimited number of accredited investors, but only up to 35 sophisticated investors. They have to be educated in particular this investment or any kind of investments in general. So these are the typical offerings we do. They're called exemptions. So when we do a 506B offering, we can raise money for our apartments, and we can sell securities to an unlimited number of accredited, but only up to 35 non-accredited investors. We can generally solicit or advertise, which is why I can go to Facebook and say, hey, I have this apartment deal, please invest with me. I can't do that in a 506B offering. And you can read more about these securities exemptions. They are called exempt offerings and rules here. A 506C is what you call a crowd-funded offering. So you see all these crowdfunding companies offering and advertising on the internet. They are 506B, and they're generally open only to accredited investors. And the company will verify that you're an accredited investor by examining your W-2s, tax records, and others. Whereas in a 506B offering, it's a self-accreditation. We rely on you to tell us if you're accredited. We don't actually have to go check that. I think there are some questions. Can you talk through the worst case scenario in case of a severe prolonged recession in multifamilies? So the worst case scenario is that you lose the property. Like that's the absolute worst case, where the lender forecloses on the property. Let's say the occupancy dips below, I don't know, 50%, and we're not able to basically make money in the property. Yes, it can be foreclosed by the lender, right? But does that happen? Not usually. That's why we like good locations, because when you buy in a good location, the property stays occupied. We also, one of the things you should ask your sponsors is if they have stress tested a deal, and what is the worst case occupancy they've stress tested it with. So what was let's say the occupancy in a down market for them? So it's kind of hard to tell in some markets because Austin's gone through a huge amount of change. So can I compare it to 2008? Probably not quite very well, because the economy has grown so much and number of people have grown so much. So you can just do a best guess and do a worst case scenario and ask the sponsor what they've done to figure out what the lowest occupancy they've seen in those apartments are. Do the investors get the benefit of the increase in the equity over time if it occurs? Absolutely. It's an equity investment. You will see the benefit of the increase in equity of the property. So I'll just get to some of the common documents. Private placement memorandum. These are common documents you will see in a 506B or a 506E offering. It's a legal document which is provided to investors, prospective investors, when selling any securities like our stock. It describes all what the company is, and we have to do this. We will give you a PPM if you invest in one of these offerings. The terms of the offering as well as the risks of the investment. So we have to highlight the risks of the investment. Yes, you could lose the property. Yes, it could be foreclosed. But again, we try to mitigate all those risks by buying into good areas, checking what the stress testing the deal and making sure that it'll hold up through a bad economy. Can we tell how long? As long as the property is cash flowing and there are people living in it, we are able to hold it through a recession. Yes, multifamilies are treated as securities. No, multifamilies are not treated as securities. The offering that we put together is treated as a security, and it has to go by the SEC rules. Subscription agreement is something, again, you'll see. These are sold as a specific number of shares at a price, let's say $1,000 a share. So if you buy 50 shares, you have a specific portion or percentage of the property. And this will be detailed in the subscription agreement. The operating agreement is a legal document which defines what each person's roles and responsibilities are, like who's running the company, who's running the day-to-day, obviously the sponsorship team is, and it highlights all of those. An investor suitability questionnaire is like trying to find out what is it that I need to know about you as an investor. If I'm a sponsor, what's your investing experience? Are you accredited? What's your relationship? In some 506B offerings, we cannot take money from strangers. So we need to establish that relationship first and get to know you and understand your investing experience before we can say, okay, you are a good investor for us. So there's got to be a match there. Ways to invest: you can invest with cash, you can invest with self-directed IRAs, or you can invest with a solo 401k or a qualified retirement plan. So the cash is, we issue K1s, you have tax implications, but because there is a lot of depreciation, your cash distributions may be offset by that. With the self-directed IRA, you can invest into an apartment syndication. You can roll this self-directed and create it with an employee IRA. And I'm happy to, if you have any questions about how to create or set up a self-directed or a QRP, which I highly recommend, because there's something called UBIT, which is unrelated business income tax that will be charged on the leverage portion of the gain in a self-directed IRA. But this does not apply to a solo 401k or what we call a QRP. So you are able to, even as a W-2 employee, set up a QRP, and I can help you with that, and I can guide you and guide you to people who can help you with that as well. So you don't have to deal with UBIT. You can set up your own QRP, have check writing capabilities, and use that as a normal account to invest and manage your investments. So any other questions? I think I have some more questions here. Can passive investors use personal bank loans to invest in syndications? I don't see why not, although I don't think I would do that only if there's enough spread between your bank loan and what you're making in that investment, right? So what happens is, let's say you get a personal bank loan at 5%. And if you're going to make a 10% cash flow, and you'll have to pay on that personal bank loan as well. So we don't really look at where your money is coming from. Like, we are not like mortgage brokers who examine where your down payment's coming from. We don't. So I don't see why not. But I don't know if I would recommend to every investor to take a loan to invest into this, because what happens if there's a downturn and you don't get cash flow, right? You want to make sure that you can still pay your personal bank loan that you made. Do investors have any say in the decisions made? they do have some amount to say, although they don't have any say in the day-to-days of the property. But let's say we want to sell in 2 years. We do ask our investors, hey, is everybody on board with this? We are making 40% returns in 2 years, which is 20% annualized. Are you guys happy if we sell it right now? We might do that in some cases. Like we recently bought a property, we decided to sell it in, we decided, or we think we'll sell it in 18 months. And so we will take that investor consensus on that and go ahead and sell it if everybody agrees. So is this an REI crowdfunded real estate investment? It is not a it's crowdfunded in the sense of, yes, it is a pool of investors, but it's not crowdfunded in the sense there's no online portal that it's crowdfunded through some third party. It's basically people, we get together like sponsors, we get together, we form a syndication and we present a property. So it's similar to the crowdfunding model. A 506c would be a crowdfunded. But I think the biggest advantage of going to a crowdfunding platform versus investing with me and other sponsors is that you actually get to know us personally. So whereas in a crowdfunding platform, you go to CrowdStreet, let's say you invest. I actually did that. I invested in realty shares. I did one investment. I lost the complete other investment completely in a good economy because the sponsor hadn't been vet properly. So here you're relying on yourself to vet the sponsor. There you're expecting the platform to vet the sponsor. What's the average interest rate that the investor can expect? So over every year, about 15 to 17% on their money. And like I said, the total returns will be 15 to 17 per year, paid out differently. Like there's a cash on cash portion and there's an equity portion. How does the syndicator get paid? The syndicators get paid in splits. So usually, let's say there's an 80-20 split. So 80% of all the profits go to the investors and 20% to the sponsors. Let's say you don't make that much profit, like we do something called preferred returns, which is let's say 8% pref. It means that 100% of the profits go to the investors up to 8%. If we make more than 8%, 8 to 10, let's say we make 10%, off that 2% extra, we get paid 80-20 split, which is we get the 20% off that 2%. I hope that's clear. I'm not sure what a curated opportunity is, but any other questions? Okay. So since I've been answering questions as I go along, I don't think there'll be a lot of questions for later. So just wanted to say, stay tuned for our future webinars. Actually have a next webinar on qualified retirement plans. We have an expert in this field, Damian Lupo. He'll be coming, talking to us on what a qualified retirement plan is, how you can set one up. And he has a company which actually does that. So I'm happy to present him for the next webinar, which will be next Wednesday at the same time, 7:30 p.m. I will be sending out an email later today inviting people for this webinar. So you're welcome to join next week at the same time. If you need to get hold of me, here are some of the ways. I have a Facebook group called Purely Passive Investor Group. I not only look at multifamily investment, I personally do multifamily, but I'm also looking at other opportunities in senior assisted living and hotels and other investments that you can passively invest in. So that's an option.